Joining me now is Charles Schwab's chief investment strategist, Ann Sonders. And Ann, great to have you today. Wonder what the market action is telling you here, whether it's about, how high the bar is for earnings results, or whether we're starting to doubt the soft landing scenario that pretty much had infused markets for months now.
I do think that there is some doubt with regard to the soft landing scenario, and I think Dudley's comments reinforce that when you look at the lift off the lows in the unemployment rate and some other cracks that we're seeing, not just in the labor market and potentially a double dip in housing and manufacturing kind of heading slightly lower again after some hope that it was going to pick up. I think obviously the lift in small caps started with the more benign CPI report, but I think what's happening now is there's a bit of differentiation within the small cap universe, and our take has been you want to fade the low quality part of that move, because with this extreme outperformance on the part of small caps has come a huge drop in forward earnings estimates for that index. And I think that just highlights that there's still a lot of zombie companies, non-profitable companies. And if you want to look for opportunities and lean into this rotation, you definitely want to stay up in quality.
Yeah, it's an interesting point. And Lizanne, one thing that I've been hitting on is normally when you see this huge surge in the Russell 2000, a lot of the lower quality laggard parts of the market, that signifies really, an early cycle move or the end of a recession or something, bad in the economy that's going away. It seems not to be the situation we're in right now. And I guess the other piece of it is we're starting to ask about the resilience of the underlying economy here to some degree. And we had that, op-ed by former New York Fed President Bill Dudley today saying the Fed should cut rates in July. It feeds into a sort of a sub-narrative that's been going on right now. It feels like the market's at least sensitive to the downside risk at the moment.
Yeah, we had the Goldilocks moment in the aftermath of the CPI report. We do have GDP and the nowcast kind of hanging in there, but I think that hope for Goldilocks persisting may have dampened a little bit, and we're at that point where it's not just about monetary policy expectations, but the underlying health of the economy. And now it's not just that bad news is good news from the perspective of what the Fed is going to do, but what does it mean for the economy and earnings? We saw so much valuation expansion without a commensurate lift on the earnings front. And now that we've started earnings season, certainly with some of the mega cap misses, profit taking has kicked in.
Now, that being said, I mean, even if you looked at the projections, the broader group of stocks outside of the real kind of secular growth areas weren't really supposed to start carrying their weight on the earnings growth side until later this year. So right now we sit with the S&P like 4% off a record high. Arguably, it came in fully valued into July. It's, sentiment was pretty optimistic, you could argue. And so we're working some of that off. And I guess the question is, sure, the market's concerned with the possibility that the economy falters. Are you concerned about it, or how would you navigate it through investing?
Well, keep in mind that even before the CPI report, when the S&P and the NASDAQ were at all-time highs, and I think we talked about it on this program a couple of times, at the point where you had no more than a 7% maximum drawdown in the NASDAQ at the index level, the member has had a 40% maximum drawdown. So this idea that the market has been incredibly resilient in the face of all these uncertainties, be it monetary policy, the election, geopolitics, wars, et cetera, all you have to do is look under the surface of the cap-weighted indexes to see that there has been a lot of churn and turmoil. That in turn bred opportunity, because that valuation gap is so significant between the Magnificent Seven and the rest of the market. And I think there was that setup for convergence here, and that convergence is actually supported by the forward estimates, Mike, to your point, where by the third or fourth quarter this year, you will have seen the Mag 7 forward estimates come down and the rest of the market catch up. And I think that's been part of the basis, the fundamental basis for this rotation that we've seen.